it's an interesting issue. When you step back and look at the Australian economy, there's principally two things that really drive the Australian economy. One of those is resources and commodities markets, which obviously Australia is quite rich in, and the other is the housing market and construction industry. In terms of when you look at the affordability of Australian property relative to other international economies, Australia the prices of property in Australia are very, very high. Particularly in the metropolitan regions, they could be as high as 9.1 times the income limits, whereas in the States they're closer to 2. That was at the beginning of the GFC. And so I think it's right to be acutely aware whenever there's any fiscal stimulus package that includes first-time owners grants, particularly young people that may not be in a position to afford it. So I agree with Simon's comments. Hopefully, as banks are now starting to review and stiffen up their lending practices and to reduce LVR rates and to apply high level of scrutiny on the lending practices, hopefully that will counter that argument. I guess the key distinction between Australia's property markets and the States is really one of economics, supply and demand. And fortunately for Australia, and again I guess I speak more in the metropolitan regions, there is a very, very high demand for property, and hence that's what's driving the rental rates up and the yields. So I guess there's some counter arguments in that perspective. In terms of the impact to Australia, to answer its first question, I think it's going to be an interesting series of events to watch as this unfolds. I think right at the moment Australia is putting in place some practices to try and mitigate against any further potential global downturn. I think some positive signs have been recent Chinese recovery, which is quite promising for Australia. I think we've got a healthy balance of exports, so we're more on the resources rather than capital goods and manufactured goods. The interest rate falls that we've had, 425 basis points, have been quite beneficial, and that's something that's only being applied now post the GFC as opposed to prior to GFC, as like the States. So there's some positive things there, some exchange rate depreciation. So there's some strengths. I think there's also some concerns in the Australian economy, and so it's really going to be contingent on how the global events, as Glenn was sharing earlier, play out and the impact that has on Australia's economy. As far as our defaults are concerned, I see there's significant increases in defaults right across many sectors. Even in strong sectors like construction, we've had many companies heavily geared. Right across every sector, there's been very, very heavy gearing over the past 6 years to take advantage of market opportunities, but now they've been caught with access problems to funding and liquidity. So there's been substantial funding risk as debt matures. And what's happened to a lot of companies that have previously gone into aggressive growth and expanded offshore, they've had to contract, had big losses, they've paid heavy premiums, so bigger tangibles in their balance sheets for offshore acquisitions. Now they've had to divest them, it's impacted the balance sheets here, and so they've quite a severe impact. But whether you look across the discretionary spend areas, from your cafes and your coffee shops to construction, across all sorts of, a very obvious one is automotive finance, where almost overnight was a complete withdrawal from the market. This is going to continue to play out. I think the next interesting sector to watch is going to be insurance. And for those that are familiar with the insurance industry, when you look at the balance sheets, they've been hit with a double whammy. So on the asset side, they're obviously valuing their assets, which have substantially deteriorated in light of the economic scenario. On the other side, the liability side has substantially increased. So what's happening is a significant change in terms of their net worth positions. So they've had to put freezers on their books as far as what they're able to continue to insure for many, many sectors and also traditional clients. And that's going to have a big implication in terms of Australian business right across the country. So I think that's an interesting sector to watch moving forward.
We'll have to wrap up shortly, but what I wanted to do before we did that, any questions from the floor? We've had a good session here. Yes,
yeah, can I ask a question? I understand that securitization is a very complicated process. Does the investor really understand what they are buying in terms of the security those SPV issued, or are they just relying on the the rating agency, the ratings?
I think maybe part of both. It's a great question. It's a really pertinent question. I think there's certainly reliance on the ratings. I think that standardises and makes them tradable. So I think that's a huge part of it. So ratings are a big thing, and I wouldn't say that, especially near the end of the sort of boom before the global financial crisis, I'm not sure investors at the tail end would have completely understood the risk they were taking on their on their balance sheet into their fund. A lot of it ended up with funds, managed funds or some kind of hedge fund. So they wouldn't analyse every risk. Having said that, I'm not sure if anyone in the system really knew the magnitude of the risks. So I don't think it can all, it can't be laid with the funds, it can't be laid with the ratings agencies, it can't be laid with the regulators. I think the nature of the system has become so complicated that I don't think anybody knows the true nature. And even now, it will take years to unwind all those cross-connecting situations. If you look at the way some of those bonds are then insured and counterparties to those particular transactions, i.e., American huge one. They were big pioneers in the credit default swap space. And so, what happens when they get downgraded? What's the flow-on effect? So I don't think anyone really understands the contagion effect throughout the system. Having said that, I think they do really heavily rely on ratings agencies, who themselves aren't in a position to understand, as nobody is, although they are at the forefront of that knowledge.
Yeah, no, look, I agree with Glenn. Just really briefly, conscious of time. I think the key issue around securitisation, I agree. Investors, I don't think, are fully or acutely aware of the complex nature of the instruments and the risks associated with those instruments. I think the ratings agencies are therefore heavily relied on by the markets at large to explain to them in very, very simple terms what's the likely risk of this particular package. I think one of the key issues has been the assumption that many of the senior ratings agencies have employed in terms of providing ratings on those packages is reducing risk through diversification. So when you have an aggregated portfolio, for example, of subprime assets right across the country, the assumption is even if there's a region-specific, through diversification risk, it shouldn't have a portfolio-wide perspective. However, the challenge in this scenario obviously has been it's been a country-wide issue, and so that's the real challenge. So I guess that impacts prudential regulators, supervisors, the lending institutions themselves to revisit the practices that they employ in terms of ascertaining both scenario and sensitivity analyses and stress testing their portfolios for specific events. I hope that answers your question.
Final question?
I just wanted to know, we're so heavily reliant on the ratings agencies, but can they ever be held liable when they've maybe underestimated the risk, like legally liable?
That's a really good question. Like I said earlier, one of the key principles of a good rating agency is it's an agency that will stand behind its ratings, the ratings that it provides. And we do. And fortunately, sure, we've been in Australia, so we've benefited from a relatively benign credit environment, but we've got an impeccable track record and we're not yet far. Having said that, let me also share with you that the senior ratings agencies will heavily qualify their assessments on certain assumptions. And at the end of the day, buyers aware, unfortunately many buyers haven't been aware of the core assumptions that were incorporated in the reports. And so from that point of view, contractually, I don't see a liability. But having said that, I'm not a legal specialist, I'm a chartered accountant, and not those matters are best left to the lawyers.
I think I might just add to that one, is that I think I mentioned to you before in the lectures that when I contacted a number of the major credit ratings agencies, what they all emphasised and what they've all got on their websites is that a rating is an opinion, not fact. And they do rely behind that, virtually saying that therefore you must be satisfied for yourself if you are going to rely upon it for investment purposes or other purposes. So I think that that partly overcomes the legal sort of aspects. That's what they rely upon. Okay? I think we'll have to wrap it up now because it is now 5 o'clock, and I would like to thank our guests here. I think that they've done a fabulous job. It hasn't embarrassed me in any ways in terms of the things that I've told you with lectures, which is a bit of a relief as well. But I hope that you show your appreciation for what they've done in the usual manner. Thank you very much. Thank the media unit.